You can tout drill baby drill all day long. Drill baby doesn't work when you only have a shovel in one hand and 2 pennies in the next. You know, sometimes there's acronyms in various industries that you just look at and go, well, I'm sure it means something, but I have no idea what it means. With people or those that are particularly involved in the oil and gas industry here in the United States, especially on the exploration side, we're very familiar with an acronym called a DUC, a DUC. It stands for Drilled Uncompleted. What has happened is the oil industry figured out about 10 to 15 years ago that the oil and gas success of all these shale basins around the U.S. were really just a large land play. It was a land rush. You had to get a lease, secure a rig, drill the well within a certain time frame, and by virtue of successfully drilling a well, you earn the right of development and future harvesting of reserves in place in perpetuity forever as a result of drilling wells within that lease term. Then they figured out, well, look, there's too many open acres. I can lease 100,000 acres, but I can't get a drilling rig to move there fast enough if I drill the well horizontally and then I spend a third to half of my capital in completing or turning the well online. But if I can just drill the well, it honors the terms of the lease, which allows me to hold that future development right in perpetuity forever. So they decided, the oil companies decided, let's go drill as many wells as we can and let's postpone completing them. Let's stack up this huge inventory of DUCs, drilled uncompleted wells. So from about 2014 until about 2019, we saw an exponential increase in the amount of drilled uncompleted wells in this country. It went from about 5,900 DUCs to almost 10,500 drilled uncompleted wells. Then we saw COVID happen. The economy slowed down. We went from about 1,200 drilling rigs in 2018 to about 900 drilling rigs by 2019. We dropped as low as 216 rigs in 2020, which is in the height of COVID. So that's a massive drop in activation. So the U.S. said, look, we're not producing, wells are shut in, the economy shut in, storage tanks were full, nobody was buying gasoline at the gas station, everybody was home eating Cheetos. So you had this huge destruction in immediate demand relative to a pandemic. On the backside of that came the reality. Wait a minute, everybody's coming out of their houses, they're back on the road, businesses are starting up again. We got this huge demand for houses and construction and et cetera. Now suddenly we need all the oil that we were producing prior to that shutdown. Well, the oil and gas industry said, wait a minute, we've been drilling wells but not completing them. Now we have this massive inventory of over 10,000 drilled uncompleted wells. Our production dropped to about 9.9 million barrels a day from 11 million barrels a day. We lost basically 11% of daily production. How do we get that back? Well, we can't go drill because there's not enough crews and people. We got COVID. We got all kinds of rules and regulations depending on what state you're in. So the oil company said, look, the fastest, safest way for us to put capital to work is spend the money to complete those wells, turn them online. We get big flush production. Our banks are happy, our shareholders are happy, we're adding cash flow, we're adding reserves, it's proven. And what we're doing is we're going to develop the easiest low-hanging fruit. Now, why do I hammer in and why do I focus on drilled uncompleted wells? Well, if I look at it from a technical perspective, it's my estimate out of the remaining 5,972 DUCs that are on the books as of this morning, probably 3,500 to 4,000 of those drilled uncompleted wells will never be completed. Why not? The original company that drilled it 7 years ago, they drilled it out and they only went 1 mile. They didn't have the tools we have today. So the landing zone they were supposed to be in, they were only in it for 20 or 30% of the time. It also is relative to the cost of completion. Completions have changed. 7, 8 years ago, we were putting in 5, 10, 15 million pounds of sand per well. Today, by that standard, means you're not even fracking. Now we need 22 to 35 million pounds per sand per well. Well, I'm not going to do that if I have a well that's not in the landing zone. I'm going to be fracking basically non-productive reservoir. I'm not going to frack and spend that kind of money on a 1 mile lateral. Now I'd rather have a 2 mile lateral or 3 mile lateral. So I look at, as an operation company, yeah, we bought an asset base. Within that asset base, there's 45 drilled uncompleted wells. We're not completing but 3 of them. The other ones are either non-economical, do not make standard comparison by today's standards of drilling, accuracy, landing zone, completion, and fracking. So guess what? Out of the 5,972 DUCs, probably 3,500 to 4,000 will never be completed. Now, why does that matter to you and me? From a practical standpoint, it's like looking in your barn and you got a herd of cattle to feed and you go, I got plenty of hay in the barn, I got plenty of feed in the barn. And you go pull that first bale out and you find out your kids were making forts and behind that first bale, there's no hay behind it. So when we see 5,972 DUCs, we think we have 5,972 wells ready to go, be fracked and turned online. The oil industry drilled as many wells as they could the last 6 years. They turned on almost 5,900 drilled and completed wells. And with that, we've leveled off at 13.6 million barrels a day. We've hit the peak. The peak was based on wells that are drilling and activation, the number of DUCs they could quickly bring online, the low-hanging fruit, and a combination of those two things gave us a 3 million barrel rise in daily output. Now all of a sudden we're looking around saying, wait, nobody's giving us capital. There's no bank lines to be had. We're looking at a higher increase in demand even before the Iranian war. We're looking at supplies in heavy demand all over the globe. We've got vessels headed toward the ports here in the United States to pick up our crude oil. We're exporting oil. But the United States oil and gas industry is saying one thing. Ladies and gentlemen, you forgot to ask us, can we give you more oil? You forgot to ask us how we're going to keep up with the current rate of production. If new horizontal wells come online with a 40 to 70% decline the first year, we've got to replace 40 to 70% of today's production and a continual basis of new wells being fracked and turned to sales just to keep even. Well, if we're lowering rigs, and we've been laying down rigs, and we find ourselves in a position where most of the tier one minerals are being developed today and will be developed over the next 10 years, we can see a fundamental problem 7 to 10 years out, which is what? We don't have enough low-risk locations in tier one minerals. We don't have any more drilled and completed wells we can tap into for immediate production. We have a limitation on crews and manpower and drilling rigs that are active and available. We have a tightening of debt, tightening of capital that can be deployed as a result of our companies, the U.S. oil and gas industry, living strictly on our cash flow. And that cataclysmic future looks like what? You can tout drill, baby, drill all day long. Drill, baby, doesn't work when you only have a shovel in one hand and 2 pennies in the next. We have been capital devoid. We've been punished by being successful. We've been encouraged or at least reassured that the White House's goal is to get us to sell oil at $55 a barrel, lower than what it takes to break even. And guess what? We stopped drilling DUCs. We're using the inventory we have. We're using the bales of hay in the barn. We've been using that for the last 4 years. We don't have any more hay in the barn. We don't have enough drilling rigs. We don't have enough crews. And today we plateaued at 13.5 million barrels a day, and it's going down very slow. You'll see this continual decline in daily output. No more DUCs to come in and make up the difference between new wells being drilled and older wells that are drilled just needing to be completed. And we have a problem here in the States. I don't suspect, unless there's a significant rise in oil prices with sustainability in terms of long-term forecasting, let's say $85 to $90 a barrel for the next 12, 24, 36 months, you're going to see the oil and gas industry not add new rigs. They're going to go at the same pace, drill the wells they have, and they're going to take the economic benefit of higher prices for longer. Drilled uncompleted. It's a great speedometer indicator. And when I see that speedometer showing empty on DUCs, when I show it going lower in speed, when I see production output starting to decline, everything I've said the last 2 or 3 years about DUCs and the importance of DUCs, to me, it's one of the leading indicators of where our industry as a U.S. oil and gas industry exists today. We are running out of answers to deliver the amount of oil every day that we need, and we don't have any solution short term for that other than much higher prices to financially incentivize us to drill more wells. I'm Troy Eckard. Thanks for listening.